Hi, this is Alessio. Hope you're well. In this video, I want to bring your attention to a big mistake that I see people making when looking at charts. In fact, in this video, I want to take a look at Bitcoin and also the charts of some of the stock markets. And I want to explain to you what this potential mistake or error actually is. As a matter of fact, I brought this to your attention back in April, as you can see here. And in this video, I want to give you more information about it. So this is going to be quite an important video. Now, before we go into that, I want to first of all just mention something very quickly. In my most recent video, which I posted last week, I think in my last two videos, you may remember that I said that I took the majority of my profits. So on the long trade that I had back for the last few months, I said I took the majority of my profits here as the markets were hitting resistance at the 3,200 levels. Now, you probably already know the reasons for this already. I've already explained this in my previous videos. I won't repeat it all over again. But essentially, I took the majority of my profits here at near 3,200 as the markets were hitting resistance. And also the fact that people were extremely over bullish, getting extremely euphoric and over bullish here. So I think that was the right decision to make here to take profits at that level. We've seen already the markets respond by having a correction, or what seems to be at least a pullback. But let me also say this. I read a lot of bearish comments too. It seems a lot of people suddenly got extremely bearish last week. So what happened was that after the markets hit this resistance of 3,200, again, massive euphoria and over bullishness here at near 3,200, suddenly, because of the drop we had last week, we went into the exact opposite. In fact, sentiment, public opinion sentiment, shifted from over bullish to bearish within just a few days. As a matter of fact, my good friend Charlie Burton, he mentioned this in his most recent video. Listen to this.
But interestingly, what's just happened, we just had this huge down day yesterday in the stock markets, and immediately they've all, I say all, but a large percentage of them have flipped. They flipped from being, long the stock market to very quickly yesterday and even into today have flipped over and switched to buying short-based exchange-traded funds. Exchange-traded funds which will make them money if the stock market continues to go down.
So guys, I think Charlie had a very good point there. People went from being extremely bullish and long here to suddenly becoming the exact opposite right about here, going extremely bearish. So bottom line is, guys, that I think we need to be very cautious here. The reason is this. I mentioned this in my previous video, and I want to mention it again in this video. If you look at this chart, you will see something very important. Despite the drop that we had last week, you will see that the structure of the uptrend has not yet changed. I mean, guys, just take a look at this chart right here. And you tell me, do you see an uptrend or do you see a downtrend? Has the uptrend been reversed? I would say, as far as I can see, the structure of the uptrend has not yet altered because we're still in this trend channel. So I just want to put this caution out there because I think a lot of people are getting extremely bearish right now just because of the few days of selling we've seen in the markets. But all I can say is, guys, that as far as the chart is concerned, and again, it's important that we make decisions based on what we see on the charts, not on what we think or how we feel. All right, guys? So always make decisions based on what you see, not on what you think or how you feel. Bottom line is, guys, that as far as I can see on this chart, we're still in an uptrending structure. All right, guys? And until the structure changes, until we break out of the structural uptrend, again, we need to remain cautious and not jump to conclusions and not become extremely bearish on the market. So as far as the trend is concerned, the uptrend is still intact. It's still there. So the trend is your friend, as the famous saying goes. Now, don't get me wrong here, guys. Eventually, we're going to break this uptrend. Eventually, we're going to see a retracement. I think in the next few weeks and months, I'm expecting this market eventually to see a major retracement, a major drop, and break out of this uptrend. Yes, I'm expecting that. But at the moment, as I'm seeing it here, guys, this is still an uptrending structure, and we're still inside this channel that we're seeing here on this chart. So let's just be patient and be cautious and not follow the herd. When the market wants to break trend, it will tell us eventually when it breaks out of this uptrend. All right, guys, I want to talk to you now about a major mistake people are making in chart analysis, which, by the way, could save you years of frustration once you learn what it is. So take a look at this chart and you'll see something important. So you will see, first of all, that as the market dropped last week, we formed essentially a gap. That's what's called a gap down. Okay, now I'll explain to you more about that. And this is what's called a gap up. So gap up, gap down. During the crash in March, let's just go to the crash in March, you will see loads and loads of gap downs. By the way, for those of you not familiar with the term gap down, Let me just quickly explain to you what that is, essentially what gaps are. So essentially gaps are what you see here on the chart, these holes that are formed on the chart. What's happening is that here the price opens below the closing price of the previous day, the previous bar, causing a hole or a gap you see on the chart. And essentially in technical analysis, the theory is that when a gap forms, when a gap down, for example, forms like this, as you're seeing here. So when you see a gap or a hole in the chart, the theory goes that the price usually has a tendency to fill that hole. In other words, to fill the gap. In other words, that there's a tendency for the price to move back and penetrate the area of that hole and fill the hole, essentially, as you can see here. Now, you may remember back in my video in April, here it is. So this is my video on April 1st. Now, the video I made back then was a bit shaky. The camera shook quite a bit, so I don't want to play it all over again. But you can see I had much longer hair than I have now. Bottom line is that I was pointing to the chart and I was saying, look, there's several gap downs that have not yet been filled. That's quite important, by the way. I'll explain to you why in this moment. And in that video, you can see I was pointing to the chart and I was saying, look, these gaps on the chart, at the time, the price of the market, I think the S&P was at 25.84. So we're still down here. And I said, look, when you see these gaps on the chart, just be aware that means there's a high probability that the market could go back up and fill those gaps. So the bottom line, why that was so important, was because it was giving us a directional bias. All right, guys? So the meaning behind the video was, when I was talking about these gaps, was that there's a directional bias on the chart for us to go back and fill those gaps on the chart. All right, guys, so you can see this is the crash in March, and you can see how many gaps we formed here. And you can see there's several gaps here that have not yet been filled. The one back in late February, early March, about 3,300 levels here. But these gaps down here, they were all filled, okay? Now, when we talk about these gaps being filled, what are we talking about? We're talking about the price eventually going back. Okay, let me just shrink this a little bit so we can see. Yeah, essentially the price going back and filling those gaps. In other words, going to the territory of those gaps. Okay, you can see exactly what happened there. We went in the territory of that gap, filling the hole, putting it in simple terms. All right, guys, so far, all these gaps down here have been filled. But here's something else you'll notice. Notice that on the way up, we formed other kinds of gaps. These are what's called gap ups. So gap ups are the gaps that form on the way up, like one over here. Notice as the market bottomed here, it formed this gap up right down here, about at 2,300 levels here, as you can see. Now, a major mistake people make about these gaps is that they think that a gap up has the same probability as a gap down. And guys, the fact is, that is not true. Gap downs, like you see here, okay, a downward gap, does not have the same probability as a gap up, okay? So which one do you think has the higher probability of filling? Do you think it's a gap up or a gap down? The answer is a gap down. A gap down has a much better and a higher probability of filling than a gap up. It's often a mistake, it's often a misconception people have, that they think all gaps are equal. No, all gaps are not equal. And that is a dangerous assumption to make. The same is also true, I would say, for other kinds of individual stocks and Bitcoin as well. So we'll come back to that in a few minutes. But the bottom line is this, guys. Please don't make the assumption that all gaps are equal. By the way, in case you're wondering, why are there so many gaps in March? What was going on here in March that was causing so many gaps here? What was happening, guys, is that the fear and the panic behind this crash, because of course the mainstream media was talking about it as well, produced a sudden panic and fear among the public and produced what's called a get me out mentality. In fact, Jason Gepper talked about this back in this period in March. He said it's what's called a get me out mentality. Essentially, people were just saying, look, I don't care, just get me out of this market now. So people were just getting desperate to get out of the market. So that was a get me out mentality. So what's happened is we've gone from a get me out mentality to a get me in mentality. But the important part I want to bring to your attention is this. Gap downs do not have the same probability as a gap up. For example, take a look at this chart. 2016. This is 2016 on the S&P. This particular gap down here from June of 2016, after the Brexit vote came in, after the Brexit vote, a few days later we gapped up, and that gap, guys, has not yet been filled. That has not filled for several years, since 2016. So again, guys, if anyone tells you that all gaps are equal, that is a mistake. That is not correct. By the way, the same is correct with this gap over here. This gap over here, you see this? That was about the 2100, 2080 level, that gap also has not been filled as yet. So you have to remember, guys, there's a distinction between a gap up and a gap down, and gap ups, like you see here, have a lower probability of filling. So I would never bet in the direction of that gap. All right, so for example, if a market gaps up like that, all right, if I see a market gapping up like this, like here and here, I wouldn't be trading in the direction to fill that gap. And I would not have a high expectation for the market to go back and fill that gap. However, a gap down, like you see here, a gap down do often get filled, like you see here. That gap down, in fact, did get filled. And this is actually a fact about the market, guys. The fact is that in the entire history of the stock market, all gap downs have always been filled. By the way, people think that gaps are equal on individual stocks like Netflix or Apple. That is not the case, guys. I would never trade gaps on individual stocks. On indices like the S&P, like the Dow, for example, like these particular markets, yes, that's fine. But on individual stocks, no, I would not be trading them. I would not be trading those gaps. Now, in case you're wondering, why is this? Why is it that gaps on indices fill more often than gaps on individual stocks like Netflix or Apple and things like that? The reason is, one potential reason is that because indices are baskets of different stocks, they are baskets of different stocks from different industries, different sectors, and so on, they have a much higher probability of filling, okay? Because you're not just dealing with one stock. You're dealing with a basket of different stocks from different industries. So that's why I prefer the gaps on indices and not the gaps on individual stocks. So the bottom line is, as far as individual stocks are concerned, I would not place any bets on gaps on these particular markets or on individual stocks. Now, what about Bitcoin? I have noticed that on Bitcoin, there is a tendency for it to fill gaps, also especially on gap downs. I mentioned this, in fact, back in April. I said that this particular gap on the CME chart of Bitcoin very likely was going to fill. So I found a tendency for Bitcoin to fill the gap downs. Now let me say, I don't have all the statistics. I don't have all the data on Bitcoin gaps. At some point we'll do that. But from what I can see, I see gap downs, like one over here, and one also over here in May. You can see that there was a gap down here in May. These gaps, these gap downs, also have a tendency to fill. So if you believe that Bitcoin has a tendency to go up in value, to go up in the long term, I mean, I guess you could argue that gap downs would have a higher probability of filling in the medium to long term. Now, I should say that I don't have all the statistics on gap ups or gap downs. Gap ups, I think, have a lower probability of filling personally. So if I see a gap up in Bitcoin, I would say that has probably a lower probability of filling than a gap down. But that would require some more research.